Welcome back, everybody, to the second half of how to prepare for your annual insurance renewal workshop. If you're just joining us, I'm joined by Nathan Spears. We had a great first hour. Now it's time to jump into the second hour. Went over a lot of great stuff. So let's just dive right back in. Actually, before we do that, we've actually got a question from Kenneth Shock. Hey, Nathan, have you been able to learn anything more about the insurance business here in Canada? Do you write in Canada or just in the U.S.?
I remember you. I met you at Lab Live, and when you told me the premiums you guys were paying, I'd love to write in Canada. I have not. I have no idea what it would take for me to get Canadian licensure. I suspect it might have a lot to do with citizenry or the lack thereof. Thank you for asking and reminding me. I am interested in that, and so you've reminded me to look into that. We may have some domestic carriers here that do write in Canada for all I know. So,
Is just something you've never really explored?
It's never really occurred to me. I mean, I've met international operators at LCT and stuff like that, and I suppose I have. It's crossed my mind, but it's just not something I've ever embarked on. So thank you for the invitation.
Kenneth, I will stay on top of them for you.
Yeah, he will too.
All right, so let's move on to number 6, safety controls. Number 1, first, tell me what safety controls are, and then 2, why are they important? Why should I care?
Yeah, so you should care anyway. But safety controls are anything that you can employ to mitigate losses, to mitigate claims, accidents, and occurrences. Whether that's telematics, which are more sophisticated systems that record driver habits. Is he braking hard? Is he speeding? It typically comes with video. Ray Gavino could speak more to that than I can, to be perfectly honest. But telematics, GPS tracking, there's some value in that for insurance underwriters. Do you have certifiable chauffeur training? We referred to the PAX training. They're not paying us. They ought to be paying us as many times as we mention it. In-house training. What are you doing in-house to train and retrain your drivers? I personally believe that you want to stay in your drivers' faces. Touch them. Keep that relationship throughout the day. Keep them thinking in a professional headspace.
Is there any barometer or any suggestion in regards to how much continuing education, underwriters are looking for?
I don't think so.
Once a year? Once a quarter?
I think once a year would be reasonable. If somebody has safety meetings, even just having in-house safety meetings, do that quarterly. I would think you'd want to anyway. Make sure your drivers have incentive. Do they have incentive to stay squeaky clean and take care of your equipment?
Right. What if I'm a small company and I'm, a 3 to 5 car company that has 3 to 5 chauffeurs, and I'm driving and I operate out of my house, and they take the vehicles home or they're parked in my driveway. I mean, can we have a virtual meeting? Can we meet in my basement? Do we have to have an office for that safety meeting or that training? Do they go that deep, or is it just a matter of, hey, here's my safety controls because I need to deliver this to my existing broker or my new broker, right? And we have these safety meetings, and here's kind of the agenda that we go over, every quarter.
Yeah, I mean, you can have safety is an ongoing thing, especially if you're a small operator like that and you're working in the business. And by the way, I love small operators. I specialize in that. But, it can be an ongoing thing. But as your agent, I need something I can sink my teeth into. I don't want to have to just tell a story. Right. They have ongoing safety training. Duh.
So you're looking just like a document. Hey, Bill's Limousine, April 17th, 2019, Q1 safety meeting, agenda and attendees.
Give me something to work with.
Got it.
And do it.
But it doesn't need to be this elaborate 15-page deal of, here's when it was, who's attended, here's what it is, the date, and here's what we're going to go over in this meeting.
Yeah, you don't have to oversell it to me or the prospective underwriter.
Right.
If you're doing it, you're doing it. If you're not, you're not.
Right. So you mentioned PAC chauffeur training.
Yeah.
Really that's the only place that I'm aware of that you can, outside of watching Tom Mazza videos or, from back in the day, that you can really get chauffeur training. And I know that chauffeurs can go through that training, but they can also go through that training and get certified.
Yeah.
Does that certification that PAX delivers make any difference to the underwriter? Or even if I have 10 chauffeurs, what if I only have one that's certified or two that's certified? Could that be a negative if I let them know that only 2 of my 10 are certified?
Well, first of all, you probably wouldn't let them know. You just wouldn't. But does it help? Yeah, absolutely, because it's going to help you mitigate losses and keep your claims under control. It's not just going to help on paper. It's not just going to help because I can communicate that to an underwriter. It's going to help with your claims history. You simply won't have as many claims, and that's the number one thing we're looking at.
So we're kind of talking about the sum of all the parts aggregated together, right?
Yeah.
So you mentioned telematics and Ray Gavino, obviously. Does it make a difference if I'm going to invest into telematics if it's one piece of hardware or software or another? Are they looking for specific things? Like what if my video camera, my drive camera, whatever, I don't know all the different names of them, only records 5 seconds, prior to and 5 seconds after versus 15 seconds and 15 seconds or 30. Does that matter?
I would say it does matter, but you don't have to go out and spend a ton of money on a system per se. It just depends on how much control you want to have. But really what we're looking for is video.
Right.
Video helps us to mitigate claims big time in states like Tennessee, where we have what we call comparative negligence, where your chauffeur might be 50% at fault, the other party might be 50% at fault. That's great. If the video helped us come to that conclusion, despite everything the police report said, if the video helps us come to that conclusion, then we only have to pay half as much money.
And even better, if the police report brings us to the 50-50 conclusion, and then the video shows that Bill's 100% at fault, then Nathan's scared. I can't tell you how many times I've heard of people, and we never had video back in, I was way before that.
Yeah.
I think drive cams were just coming out, but how many people just in passing and talking about this, because I like to talk about the unsexy, topics in this industry. Everybody thinks it's like, hey,
that's why I'm here.
Facebook ads. You're the sexy man in the nice suit.
Insurance ain't sexy.
In the unsexy industry, right? But the unsexy industries or components of businesses is really the nuts and bolts, in my opinion.
Yeah.
It's insurance, it's your finances, all the things that we as creative types or business owners steer away from. But I can't believe the number of conversations I've had, and even last week in Dallas with these people that are running motor coaches, to where having video in their telematics has saved their ass.
Oh,
I mean, a ton of money.
Yeah, and it's not just with collision claims and so forth. Let's say you're a motor coach operator, party bus operator. You got a client in the vehicle, they fall down. Well, what if they were wasted and acting like an idiot? It's nothing our driver did, but they're trying to get our carrier to pay out. Let's go to the video. Your chauffeur is accused of saying this or that, or the chauffeur did this or that. Go to the video. Wouldn't you hate to lose faith in a good chauffeur simply because it was, a big-time client? Would you rather go to the video?
If my chauffeur said something derogatory, is that covered under my E&O insurance?
Short answer, yeah. It's really, we refer to it as EPLI, Employment Practices Liability Insurance, and it's on the rise.
Can you explain to them what it does?
Yeah, and nobody carries it. We rarely even offer it unless it comes up in conversation. But I'm glad
if you have assets, I have it.
So here's the long and short of it. If anybody, whether they're in your employ or they're a client, and they accuse one of your team members or even something that occurred on your premises, they accuse you of something inappropriate, some sort of gross discrimination, sexual misconduct, so on and so forth. You've got an EPLI exposure there. We rate that based on the number of employees you have. We rate it based on what you do, what type of operation you have. I want to give you an example. There was a lady working in an office environment. One of her coworkers is eating M&Ms. She goes, "Hey, give me one of those M&Ms." Guy leans over to give her the M&M. M&M comes flying out of the bag and conveniently falls in her cleavage. No big deal, right? But everybody laughed about it. Ha ha, wasn't that funny? She was humiliated by the experience because it brought attention to her physically. She sued her employer. Yes, it paid out. It was a $40,000 E&O claim. Ridiculous in my view, but it did happen. So that's EPLI.
But what is it? EPLI?
EPLI.
What I refer to as errors and omissions insurance, but that covered it? So what would have happened if that company didn't have EPLI?
Well, the first thing that would happen is they would have to hire their own attorneys. So, I mean, do I even need to elaborate?
So EPLI covers the attorney cost to defend.
Correct.
Number one reason to have it.
Correct. It would pay for itself immediately.
Because we're talking about how minimal the monthly premium is on that type of insurance.
Sure. I had no idea we'd get into that.
I think it's really important because there's so much risk that the owners have in this business that they don't really understand. What you just said that happened with that occurrence. If somebody says something wrong, I mean, what if you're in Penn Station, right? And I'm in Nashville. I don't know Penn Station that well. And there is a huge snowstorm. And you say, "Can I meet my driver at door number 4?" And I say, "No, you need to go out on this street at door number 6. And then you slip and fall on the ice. And then the driver runs over your foot." And my dispatcher told you that. And I record my phone calls. And then you blame us. You sue us because you wanted to go out a different door. That covered under E&O?
Well, potentially.
Or is that general liability?
Well, the car running over the person's foot thing, that's auto liability.
But you understand, I'm giving you one of my employees is telling you what to do going against your request, right? Maybe a little bit too complicated.
Well, not really. I mean, you've got exposure there. I mean, we live in a world of what ifs as agents. So yeah, you've got exposure. Use your imagination. You've got exposure.
In my world, if you're a client of mine and I post a derogatory picture one of my employees does on your Facebook page, then that's probably where that insurance, when you sue me because I've just encumbered your reputation.
I'm going to be looking closely at your coverage for situations just like that.
So, Paul Covey, with all these risks, it's amazing that we can even get out of bed in the morning. I think, honestly, Paul, that the ground transportation industry is probably one of the riskiest businesses that you can be in.
Absolutely. One of the most dangerous things we do every day is get in a vehicle.
You know exactly who I'm going to be talking about here, and we will not mention the company's name or that person's name.
Okay.
But he just renewed his policy a couple months ago and has had an accident since then. And it looks like it's going to be probably an $80,000 to $100,000 claim on the total of a Sprinter. Not at fault, but really irrelevant, correct, based on his previous loss runs and the business model, which we'll get into in some questions here in a little bit. I'm not an expert. I don't do what you do, but I'm scared to death for him right now that there's a high likelihood he may not get renewed next year. And it may be very difficult for him to find insurance to continue to operate.
It could be. In a situation like that, how many years have you been in business? Do you have prior claims history that's squeaky clean? Is this your first shock loss? We call these shock losses. In other words, it's not a litany of claims over the last year, but it's this one particular claim. Something bad happened. Yeah, it paid out a lot of money. Underwriters tend to have a better appetite, believe it or not, for a single shock loss than they do a bunch of claims frequency. The adage in our industry is frequency breeds severity.
Right.
Underwriters are going to look at these 8 claims you had last year. Yeah, they only added up to maybe $7,000, but that underwriter's thinking, wow, 8 claims and you're operating 7 units. One of these claims, sooner or later, it's going to be a whopper.
Right.
We're not comfortable with that.
So, and Paul, I want to make one thing clear. We're not trying to, scare anybody or anything like that. There's plenty of people that are actually, if you're following what, Nathan's telling you about putting your safety controls together and, really prepping your existing broker, prepping a new broker, if you are going to make a switch. But if you guys do some of this legwork and you show your process, you show your quality control, you show your safety controls, and you don't have loss runs, you potentially could look at a reduction, in your premium. What we're trying to do is bring to light all the things that we really need to do to, one, protect you, and two, to get you prepared.
Yeah, and I really want to speak to that question a little more specifically as well. This particular operator, whoever it is, you just renewed 2 months ago. Is that correct?
The one that we were just talking about? Yeah.
They renewed 2 months ago, and now they've had a shock loss. Again, how many claims have you had over the last 24 months? Over the last 36 months, over the last 5 years? Can we refer back to how exceptional an operator you are and how claims free you've been? You just had this shock loss. Furthermore, you got 10 more months before you got to renew, so it's a little premature to worry about it too much today. But I would say address it, understand what happened, and what you can do about it as an owner to prevent this from happening again.
Right. I would agree with you.
Sure, yeah.
Good stuff.
Not the end of the world.
Right. All right, number 7. Insurance isn't a maintenance program. That kind of goes back into something you just mentioned about just the aggregate of all these small claims, right? What does that mean?
Yeah, so typically we see this with larger fleets, and by larger, I mean, people that operate more than 5 units. That's the way I define it. I know that's not the industry standard definition of it, but that's when things can kind of start getting away from you sometimes if you don't have exceptional chauffeurs and so forth. You don't want to file claims for something that you can pay for yourself. The way I like to say it is, use your insurance for that which you cannot endure yourself. Don't file a $1,500 fender bender claim. Your deductible's $1,000. You're only going to get $500 out of it anyway. Let's keep it off of our claims history. That's going to serve you better. When we see, again, like I was talking about before, when we see a rash of claims activity, we say to ourselves, frequency breeds severity. We're going to have a whopper sooner or later. This guy files so many claims. What is he doing wrong? We don't know. We don't care. Tell us, explain it to us, and do something about it.
Right. So there's a lot of people actually that I think try to negotiate down the lowest deductible and then do use this as a maintenance program, especially if you get into some sprinters, minibuses that cost a little bit more to fix a fender than, going to pull apart buy a $150 2011 Lincoln front fender and spend $80 to get it painted and slap it on versus, you replace a minibus fender or whatever. That's easily $1,500, $2,000 right off the bat.
Oh yeah, I saw a guy that got rear-ended in a sprinter, I think on Limo growth yesterday, and the claim's being settled, it's being sorted out, but he's got clients that are booked for tomorrow. So he's desperately trying to find replacement doors. I appreciated that operator being proactive, being smart, instead of just thinking that it's the end of the world and I'm going to call my agent and cry to them and they're supposed to do everything for me.
Right.
It doesn't work that way.
So I think the moral of the story that I hear you saying is try to keep your loss runs as minimal as possible. We're going to get into the ratio here in just a second, which is really the next topic of, is the loss ratio. And this is kind of a matrix, an algorithm, an equation that the underwriters are looking at, correct?
Correct.
And it's claims paid divided by annual premium equals loss ratio. And you say this must be less than 25%. Can you kind of explain that, walk through that?
Yeah, step by step. So typically when an underwriter is looking at your renewal, they're going to look back anywhere from 24 months to 48 months, looking at your claims history. And it's very simple. They're going to add up the claims that were paid out over that period. So you've got that figure.
So we're not just talking a year. We're talking, that could be 2 years up to 4 years they're looking at.
Sure. If it's a new prospective carrier, then they can take their pick of the litter. Right? So yeah, they're really going to look back farther. So you take that amount and you divide it by how much money you paid in premium over that period of time, that yields a percentage, which is we call your loss ratio. And as Bill mentioned, you want to keep that at 25% or less. Some carriers, agents may agree, disagree on that figure. But in my experience, anytime you keep your loss ratio under 25%, so in other words, for every $100 you paid in premium, they never had to pay out more than $25 in claims. That way they're still making a nickel, right? So anytime you keep that under 25%, you should not see an increase in premiums, or if you do, it should be rather modest. However, is your loss ratio also indicative of a bunch of claims frequency? They're not going to be as generous if they're seeing that. I'm beating a dead horse there, but I want you guys to understand that frequency is a no-no.
So if I have 2 cars and my annual premium's $10,000, and I have $2,000 in claims, which is 20%, not 25%, that would be my loss ratio at 20%. So I'm actually probably going to be okay.
You're going to be fine. You're not going to get non-renewed. You're not going to have any issue seeking out a new carrier for the most part. And as your agent, I don't anticipate seeing an increase in premium unless it's maybe a 5 or 10% increase, something like that.
So I don't want everybody to think this is a rule.
Right.
This is a rule of thumb.
Yeah.
So if I operate in New York City right now, and I have a stretch limousine, and I had a 20% ratio, I'm not guaranteed, based on what's happened and has been in the news and now, in their legislature, that I'm not going to have an increase, correct? So it's just kind of a standard rule of thumb,
It's
right?
a standard rule of thumb. Like so many things in life, insurance is kind of liquid. It's constantly evolving. Losses go up, losses go down. Like, Progressive Insurance, for example, they look to make a 7% profit margin. 7%. And if they actually start making more than 7% in a particular market, say like the state of Tennessee, they'll actually reduce their rates.
Really?
Yeah. So it's not like they're just making money hand over fist.
That Warren Buffett's a great guy, isn't he?
Well, yeah, he's awesome.
Progressive's owned by Berkshire Hathaway, right?
Who is?
Progressive is owned by Berkshire. Or no, excuse me, that's Geico. Sorry.
Geico is Berkshire. National Indemnity
That's
is Berkshire, and we typically regard them as carriers of last resort. Some of you operators that are with National Indemnity, also known as NICO, you feel the pain.
We'll get there. We'll get there in a second.
Yeah.
So use this as your rule of thumb. I think this is something that every operator should be keeping track of, especially if they've had multiple claims in a year. Yeah. I would say, if you're spending $50,000 a year, if you've got, 5, 10 vehicles, 15 vehicles, whatever that is, what's 25%, of 50,000, right? You're really looking at about 20, what is that? Maybe 10,000, 5,000, about $7,500, dollars. You got $5,000 in claims and you have another $2,500 claim, $3,000 claim that comes in, you better look at self-insuring that and not submitting that if you can. Is that?
If you can do that, if you can endure it yourself, it's going to help with your loss ratio. And if you're having claims activity, again, you need to be preparing for your renewal 60 to 90 days out because you've got claims that are going to be contemplated. You might be seeing a sharp increase at renewal. You might be seeing a non-renewal. If you're getting non-renewed, you're not going to be particularly attractive to other carriers. So you need to be preparing.
Right. Cool. All right. So now I've got a bunch of questions that were submitted once we announced that you were here. If you guys have questions that's not about George Soros, Michael Birmingham, please get your questions ready for Nathan. Question number 1. How does a driver employment model affect premium, or does it? Is there a difference between having IOs versus having W-2s in the eyes of the carrier or underwriter?
Okay, so IO versus W-2, on the surface to me, that's a work comp question. And so we're not going to get into work comp.
From a liability standpoint, you don't see that?
From a liability standpoint, not talking about work comp here. From a liability standpoint, carriers typically don't like operators that have an IO, independent operator model. So in other words, you, the operator, you own the business. You might have 3 or 4 cars in the fleet, and then you got 3 or 4 guys that are bringing their own equipment, or maybe more than that. Carriers typically don't like that. I'm not saying you can't do it. I'm not saying it's impossible, but I am saying that you're going to limit yourself. They see it as higher risk.
So what if I own Bill's Limo, I own 5 cars on my policy, and I have 5 W-2 employees that are driving those 5 cars. But then I own 5 other sedans. I own them, and then I've got 5 Nathans that are leasing those sedans from me as independent operators.
Yeah.
Now it's messy, right?
It is. I mean, if you can, have them get their own insurance. They need to get their own individual insurance policy. We've got an operator in our market here that has moved to that model, but those chauffeurs are not in their employ. They have their own entities set up, they have their own vehicle, and they have their own insurance. So they're creating that separation.
They're a local affiliate.
Well, they are who they are, and they're great.
I mean, we're not going to get into that whole IO and versus an employee, but I think the point here is, if what I'm hearing you say is just the cleaner model that you have, the lack of confusion or to where the underwriter could see, well, are they trying to hide something here? Why are they doing this? This really isn't traditional to have 4 or 5 different components of employment and vehicle ownership and leasing. It's probably going to be harder for them to understand. And if it's harder for them to understand, it's going to be harder for them to approve and write, correct?
Well said. I mean, I could add to it, but well said.
Okay, cool. Next question. Does having a driver incentive program impact premium? And I would assume that would mean driver incentive for like no accidents, whatever the quality control would be on, maybe it's idling or speeding or, whatever that is.
Sure. Yeah. We don't often hear about it. And you could say that, yeah, I've got a driver incentive program. You get to stay employed. You don't get terminated. But no, what else are you doing to incentivize your drivers, to make them feel as though they have some, skin in the game, as we say, like you're wearing this Limo U jacket. I suggested to an operator recently who was having some claims issues, employed telematics, everything. I said, man, you want to reward these drivers for not getting involved in accidents and occurrences and maybe some other things. Maybe they carry their weight. You want to reward them some way. In my view, I don't want to give them a pay raise necessarily, and I don't want to give them, some sort of discount or something. I might give them some swag.
Right.
I work for ABC Limo Company, and the only way you can get this cool-ass hat is by being a great chauffeur.
Right.
You can't buy one. The boss has to give it to you. In my view, that creates sort of a philosophical, a mental thing.
Could be a certificate, could have their name up on the wall in the garage.
Anything like that.
Of having 6 months clean MVR, 6 years clean MVR. I mean, there's a guy up in Indianapolis, everybody, Ken Carter at Advanced Limousines. He does a great, probably the best job I've ever seen of not just driver incentive program, but total recognition, total employee culture.
Yeah.
Reach out to him. I agree with the hat. I agree with, maybe not tying it directly to pay raises. It could be lunch. Right. It could be a million different things. Right. But you got to understand what motivates those people first. Because some people are motivated by money. Some people are motivated by, hey, Nathan, great job. Some people literally want a letter to go in their file. Whatever it is, you got to find that out because everybody's motives are different.
Absolutely.
What is the real difference between an A-rated company and a B-rated carrier, and why does it matter?
Okay, so insurance companies are rated, or you might say graded, just like kids in school are. You can have an A++ rating, you can have an A+, you can have a flat A rating, you can have an A- rating, and so on. There is literally an exponential difference in the financial solvency of an A+ rated carrier versus a B+ rated carrier. When I say exponential, I think literally exponential. Just from a B plus to an A plus. I was happy to get a B plus in school. But when it comes to insurance, yeah, exponential difference in financial solvency, which speaks to their ability to stay in business and settle your claims. If they're having financial turmoil, what other kind of turmoil do they have internally? Are they not getting claims turned around in a timely fashion, so on and so forth? So, you can have a carrier that's B plus rated, and they're a strong carrier. Maybe they just haven't earned their way or worked their way up to an A rating. But, and there's a lot of differing opinions on this, but personally, I wouldn't want a carrier that's less than a B plus.
Right.
And again, it's just based on statistics. If you're in real estate, the most foreclosed on property in America is a duplex. You might be a great property manager, but you are statistically subjecting yourself to a foreclosable property by owning duplexes. So It kind of works the same way.
So why do you guys really care about this? I mean, what Nathan's talking about is you could have a claim that an A plus rated, A++ company might pay out in 2 weeks. You're waiting 3 months. So that means when you have that accident and that car is waiting to be serviced or totaled or whatever that is, you're not getting those funds to be able to replace that vehicle. Yeah. 2, go and try to close a Fortune 500 company nowadays with a B-rated company or a C-rated company.
Yeah,
you're not going to be able to do it. They're looking at insurance. They're looking at mitigating their own risk as well. They understand. They've been doing this, they've been to a country fair or two in their day, right? So if you're going to be going whale hunting and going after large corporate accounts, you better have an A or an A plus or an A++ rated company, or you're not going to be able, you're going to invest all this time, money, marketing, sales. You're going to get down to the end or in an RFP, and you're not going to be able to, acquire them.
Yeah, I would use it as a selling point. Yeah,
absolutely. All right, next question. And if you guys have any questions, Paul, thanks for joining us. Have a great afternoon. If you have questions, just drop them in the Facebook comments. We got a couple more to go. I'm sure Nathan will stay here all day, answering your questions if you need to. What are the 2 biggest mistakes you see operators make when preparing for renewals that they could easily improve upon?
Wait until the last minute, and waiting until the last minute, and waiting until the last minute.
So that's number 1. Yeah. Everybody waits till the last minute. They're probably hoping that their broker will do what you'll do and reach out to them in that 60-day or 90-day, component, and then you don't, and they just get consumed in their business, or they don't think it's important, or, hey, I waited till the last 48 hours last year, and they forgot how painful that was. So that's number 1. What's number 2?
Well, make sure that you have confidence in your agent. Your agent should be reaching out to you 30 days out or perhaps more to get the information from you. If they're not, why not?
Right.
They might be a great agent and they're just overwhelmed. It happens to me. I'm not going to lie. But we do see this as a problem in the industry. So personally, I'm going to step my game up and make sure that all of my clients have their renewals well in advance. What can you do to prepare for your renewal? Just be present, be aware, and reach out to your agent and get the ball rolling. Don't wait till the last minute to think about it, and don't feel overwhelmed or defeated by it. You should have an agent that explains things to you in such a way that you can understand and you feel empowered and not at the mercy of the insurance industry.
60 to 90 days in advance, right?
60 to 90 days, start having that conversation, especially if you've had claims.
Man, if you guys, I can't emphasize this enough, if you are not 100% confident in your agent and your broker, right here, right inside this group is a great place for you guys to start asking questions and having dialogue. Look, Nathan, outside of him looking at my laptop screen, he has no access to this. Mike Maricoli doesn't have access to it. I can't even think of anybody else's name of a broker in this industry, right? Lancer doesn't, National Indemnity doesn't, Geico doesn't, Progressive doesn't. Just start discussing this with your friends, your confidants, your peers in the industry. And if you're going to be renewed in the next 6 months, start doing it now and getting those referrals of who you should work with. And then take the information out of here of how to prepare, and you guys will be in really good shape. But don't let them string you down to the end, right?
Right. Unless you know what's going on, unless you know that you're sitting pretty and you've got nothing to worry about, your premium's going to be about the same as it was last year. Not the end of the world. If you get that renewal 4 or 5 days in advance, it looks a lot like it did last year, and we just keep moving down the road. But yeah, don't wait till the last minute. If you want to try to get a better deal, or you don't like your agent, or you've had some claims, or a combination thereof.
And I would add on to that, if you or even have a 10 to 20% chance of moving to another broker, or you do not currently have that safety and controls packet that we talked about to prepare, sure, start working on that now. Literally just schedule 90 minutes a week, to pull your information, put it into a PDF, put your branding on the front, but package it up with a bow to be able to hand it to your agent to go and sell for you. And don't wait till the last minute for that either. You guys are known for procrastination, as all human beings are. Sure. Allocate some time now to get prepared so you don't put yourself behind the 8 ball.
Yeah, make it nice and neat. I cannot stand people slinging crap at me and expecting me to...
One document, one email sent to the agent, and make it look professional.
Yeah, one email. Give me time to, work for you. It's going to increase our chances of, making you very happy.
Take the sales deck. If you guys have not grabbed the sales deck as one of your campaigns, grab that sales deck and customize it with your information so you don't have to build one from scratch. Save it as a PDF. Email it to your agent.
Sure.
All right, Nathan, I have no losses over the last year. Why did my premium go up?
No losses, and my premium.
It's impossible, right?
Anyway.
I'm at 0 on that percentage on the loss ratio. How could my premium go up?
Well, as your agent, I don't like seeing premium increases either in that scenario, because I have a healthy state of paranoia and competitive spirit. I know I need to do something to try to make you happy. You're not going to appreciate that increase. Well, the first thing we do is revise the stated values of your equipment. Factor in the depreciation of your fleet. Your $55,000 Suburban is now worth $35,000. That's going to help offset that. But to answer the question, why do premiums increase? It's called an insurance market for a reason. It fluctuates. It's liquid. Insurance carriers, sometimes they make tons of money. Sometimes they get their butt kicked because there was a hurricane that came through and wiped the seaboard out or whatever. Insurance carriers for a segment, your segment, Limo, they're going to establish a median rate, and it's going to vary from state to state. They're going to establish a median rate, and they're either going to credit and reduce that rate for you, or they're going to debit it and increase the rate based on any number of scenarios. But if you've had no claims and your rate still went up, that tells me they've gotten their butts kicked a little bit, or maybe they think they can take a rate increase.
Right.
You guys do it too, right? How many things in life does the price go down, right? So usually if you see that, it's going to be 3%, 4%, 5%. Maybe they felt underpriced anyway for the last 5 years, and they decided to take some rate.
Someone else's losses can impact that, correct?
Absolutely.
In that market. So we kind of use the accident up in New York, that limousine accident that we're all very aware of. Lawsuits aren't finalized yet. I mean, that could be a 20, 30, $40 million payout for all we know.
Right.
And even if that's not done, they're probably, and I'm getting renewed in 2 months, they're thinking about that payout now.
Sure.
If I'm renewing or shopping that same company. Agreed?
Yeah, they're anticipating. And in fact, they have to use their actuarial device to establish what we call loss reserves. So you could get a copy of your loss run, and you could have a claim that paid out $1,500, but it's got $20,000 in reserves sitting out there. And that's a pretty educated guess by the insurance company that they're going to ultimately have to pay that out, because you've got bodily injury expenses that are ongoing and unfolding, therapy, blah, 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 blah. So, yeah.
Interesting. I think that's probably one of the biggest questions I get most often is, why is my premium
Why did it
going
go up?
I've been flawless.
Tell them to call me. I'll find out.
All right, guys. That is all of our questions. Nathan and I will stay on for another minute or two. If you guys have any questions, now is the time to type it into The Facebook comments, John up in Detroit says it's not impossible. It happens to him every year. He has no loss runs, and his premium continues to go up. I think Michigan's historically a pretty difficult market to work in.
John, you're getting a sweet premium, man. You got nothing to worry about.
Does he?
You don't have a premium problem, from what you told me.
Right. Cool. Well, if we don't have any more questions, we'll wrap up. A really big, round of applause virtually for Nathan. Thank you very much for doing this.
Thank you, man. I appreciate the opportunity.
Educating our membership. I can't tell you how much it means to me that we try to serve a very similar mission, and taking time out of your day, to come and do this on, once again, it's not a sexy topic, but I think it's probably one of, at least in my opinion, in the top 3 that needs to be addressed in our industry. Yeah. So I'm proud to call you a friend, and I can't wait to be a client of yours. Thank you very much, man.
I appreciate it. Thanks a lot, Bill, and thank you guys.
Thank you, everybody, for joining us. We'll see you next month on our next workshop.